And we are going to talk about what's happening in the economy and how we can better position ourselves. How many of you would be interested in how to circumvent what's going on in the economy, how to better prepare yourself so that you can make better decisions? If that's you, you're in the right place. Hey, champions, good evening, good evening, good evening. Welcome to another Money Monday. Let's see who we have in the house. Let's light up the chat box. If you're in the house, shout it out. Let's see who we have. We have Paul, good evening, champion. I see Lloyd is in the house. Henry's in the house. Steve is in the house. Good to see you, champion. Alice is there. Great to see you, champions. Hey, if you're in the house, light up the chat box, light it up. Let there be known what's going on. Steve, Lloyd again. Good to see you, buddy. Good to see you guys. Welcome to another Money Monday. All right. So we're not out trick-or-treating right now. We're feeding our mindset. Make sense? We're gonna feed our mindset. So I'm excited today, for what we're gonna talk about. Zachary's in the house. Good to see you. Tamoy's in the house. Good to see you, champions. Hey, I'm really. Now, we are going to talk about what's happening in the economy and how we can better position ourselves. How many of you would be interested in how to circumvent what's going on in the economy, how to better prepare yourself so that you can make better decisions? If that's you, you're in the right place. You are in the right place. So I'm going to jump right into it because we have a lot of content to cover, a lot of material. And so let me share my screen and we're just going to go right into it. All right. Let's see what we can do. Now, I want to talk about a couple of things before I get into our topic today. And one is what's happening in the economy. You see, they did a survey, they did a poll, CNBC, and it said 54% of adults say they have stopped or reduced their retirement savings or contributions due to inflation. What does that mean? They stopped their retirement savings. It means as the inflation is rising, as the cost of goods is getting better, as the bag of rice is getting more expensive, the bread, the flour, the daycare, the mortgage payments, the rent payments, the car payments, the clothes, everything's getting more expensive. What have Canadians figured out they should stop doing? They figured out the best thing to stop is their retirement. Let's focus on now. So we forget about the future so we can deal with now. This is the mindset. Right? So they've put the future on pause so that they can focus. 54%, over half. You put 10 people in a room, 5 out of them have stopped or reduced their retirement savings. And this is a real thing, right? This is a real thing. This is happening. This is happening. Now, the study went on a little bit more. And it said, in addition to those 54% that cut back on putting money in their nest egg, 43% of them have already dipped into their retirement savings. And they're blaming the high inflation for these challenges, right? They're blaming the high inflation that, hey, the reason that I have to go into my nest egg, the reason that I have to reduce my RSP savings, or the reason I have to take money from my RSP is because the eggs are too expensive. The gas is too expensive. The butter is too expensive, right? Everything is going up and it's putting so much pressure on the middle income and the lower income families. They're feeling it now more than ever. In fact, some people are resorting to going back to school, getting the OSAP loan so that they can bridge the gap. It's getting that bad. It's getting that bad. And it's one of these things. Well, what should the families do? Right? They're feeling the pinch. They're not earning enough. They're not sure what to do about it. They're concerned. They're worried. But nothing happens. Nothing changes from day to day. Sandrine said, for those who have retirement savings. Exactly. Many don't. Many don't even have the retirement savings. They just surveyed the ones that had the retirement savings. And as bad as inflation is, on October 26th, last Wednesday, the Bank of Canada increased the bank rate by another 50 basis points. By another 50 basis points, right? So it's not getting better. It's not as bad as it is and as bad as it was. The Bank of Canada still deems it necessary to increase the interest rate to try and curb this inflation, what they call quantitative tightening, right? Quantitative tightening is when they want to reel the money back in. Quantitative easing is when they want to put the money in the economy. So during COVID, you saw the government doing a lot of printing of money, right? They did that with the CERB. They did that with, different handouts that they were giving, different, incentives the government was giving for people that weren't able to work, or, the businesses that weren't able to operate. They were printing money and giving money out. That's called quantitative easing, right? When they want the money back, when they want to reel the money back in, they call it quantitative tightening. And I'm going to show you a little bit of how they bring the money back, right? How the banks bring the money back in. You're going to see that today. You're going to see that today. So another survey by BNN Bloomberg, more than half of Canadians, mortgage holders, worry about payments at renewal. Why are they worried about the payments at renewal? Why is this something that they worry about? It's because as the interest rates go up, as the interest rates rise, if you're a mortgage holder, especially if you had a variable mortgage, you're coming from a low interest environment, and you're going to renew to a higher rate environment, you're going to feel something. You're going to feel something. What are you going to feel? Let's take a look at this. All right, let's dive into it. Historically speaking, interest rates have been fairly low, right? Since 2012, they've been fairly consistently low, and people have taken advantage of these low mortgage rates. All right. Now, 5 years ago, the 5-year fixed mortgage would be around 2.69%, right? If you bought a house 5 years ago, you would be paying around 2.69%. Yes, there was mortgages cheaper, but let's go with what the discounted rate was at the time. So this time 5 years ago, let's say a family purchased a house, they would have paid, or they would be paying their mortgage interest rate at 2.69%. Okay. Now, you fast forward to today, you go to Finevo Lending Group, for example, their posted rates, discounted rates, is for the same mortgage. The is now 4.59, right? So if you compare that to 5 years ago, which was 2.69, you see there's a 1.8% increase. Okay, 1.8% increase. You might say, Jermaine, well, 1.8%. What's the big deal? What's the big deal? Let's look and see what some of the concerns might be. Okay, let's take the average family and see what would happen. And I'm going to run a scenario for you, and let's see what would happen. So let's say the average person bought a home in 2017 for $1 million. Okay, 2017, purchased a home, $1 million, And they got a mortgage that was a 5-year fixed at 2.69%. That's the posted rate that you saw. All right. This family did everything they could not to go into any debt. So in terms of, they didn't get any home equity line of credits, they didn't get any second mortgages or anything, just a clean one mortgage. They purchased the house for $1 million. In order to do that, they would need to put down a 20% down payment. All right. So that's $200,000 they would need to put down. That means they would be mortgaged for $800,000. All right. So their mortgage is $800,000. Let's say they amortize that over 25 years at the 2.69%. Their mortgage payment is going to be $3,660. Okay. Their mortgage payment is going to be just over $3,600 every single month. Not bad, right? $800,000 mortgage, not bad. So they've been doing that for 5 years. Let's say they did that up to today. So what does that look like? After 5 years, they would have paid over $200,000 to the bank. Okay. $219,000 would have been paid into the bank. So out of that, there's principal, there's interest. So $120,000 goes towards the principal. That's bringing down the mortgage payment, right? And then the interest payment, $99,000, is fattening up the bank, right? That's the bank's profit. That's how the bank makes money. The bank is in business of lending money. Get this straight. All right, get this in your head. Don't think of the bank as anything other than a business. The bank is like a McDonald's. The bank is like a Tesla. The bank is like a hotel. The bank is like a restaurant. It's like any other business. What is the bank in the business of? Money, lending money, right? That's what they're in the business of. McDonald's is in the business of selling burgers. Tim Hortons is in the business of selling coffee and donuts. The bank is in the business of selling money, means lending money. So they lend money. So their interest that they would have gotten over the course of the 5 years on this 2.69% mortgage is $99,000, right? That's their profit. So the homeowner, this lovely family, is now with the balance of their mortgage, $679,000. Again, assuming they didn't take any second line of credit or second mortgage or home equity line of credit or anything of the sort. So the mortgage is clean, single mortgage, $679,000 remaining to pay off. By the way, how many people are going over the course of their 5 years without getting a home equity line of credit or a secured line of credit or something of the sort? Not many people, right? Not many people. A lot of families, what they do, they try to get money out of the house. They start doing the wraparound driveway. They start doing the concrete. They start putting in the swimming pool. They start replacing the roof. They start doing all of landscaping, replacing the driveway. All of these things they start doing. And what it does is it makes the balance never go down. It's like using the house as an ATM machine, right? You just keep pulling out the equity out of the house. Now, fast forward till today. This family decides they need to renew. Remember, they're coming from a 2.69% environment. Okay? That's where they're coming from. Now, their interest rate is at what? 4.59%. Yes or yes? Okay? So this family renews their mortgage, their $679,000 mortgage. They decide, let's renew it. 25-year amortization. The bank says the best that I can do for you is I can give you 4.59. I can't do any better than that. That's the best I can give to you. So the family does up the paper, and now they're paying $3,700. So just shy of $3,800. So their mortgage payment went up, right? Their mortgage payment went up. And let's say they say, no problem, I'll do it. I'll do it for the course of the next 5 years. So now we're going to fast forward to 2027. What is the picture going to look like? So they would have paid $227,000. All right? They would have paid $227,000. Their principal payment, so out of that 227, 82,000 of that is going to pay for the house. Let's go back for a second. In their first scenario, how much money went to the principal? 120,000. Remember, in the low interest environment, 120,000 went to what? The principal. Now, how much is going to the principal? In the high interest environment, $82,000. You see what's starting to happen here? Okay. And how much goes to interest? $145,000 is going to whose pockets? The bank's pockets, right? This is the bank's profit. All right. So now, instead of before, they were putting $99,000 towards the bank. Now, $145,000 goes towards the bank. And their interest, their remaining balance on their mortgage in 2027 would be $597,000. And on top of that, their payment went up $130 every single month, right? Assuming, again, they have no other credit, no other loans on the house, no other liens, no other line of credits or anything like that. So their payment goes up $130. You look at me and you say, Jermaine, it's $130. What's the big whoop? That's not the way to look at it. Let's calculate a few things. Let's shift our perspective a little bit. Let's see what the real impact is. All right? The real impact is not that $130. It's not even what they paid in interest in the second part. You know what the real impact is? If the mortgage rate stayed the same, so around 2.69, you know what their mortgage payment would have been? $3,109 versus that $3,796. That's a $687 difference. As you pay your mortgage, correct? When you pay your mortgage every month, what's supposed to happen to the balance of the mortgage? It's supposed to reduce. As the balance of the mortgage reduces, also the amount of money that you pay every month towards the bank also reduces. But in this case, it went up. In this case, it went up by $687. Right? It went up by $687. This is the real impact. You know what else? The total paid would have been $186,000. Okay? The total paid would have been $186,000. That's what they would have paid, the total amount. But you know what they paid instead? $227,000 I just showed you. That extra money came out of what? The family's pocket. Remember I told you quantitative easing is when they print money, they give money out, and quantitative tightening is when they bring the money back. The way they bring the money back is by increasing the interest rates. So they reel the money back into the banking system. This family doesn't have a shot, right? Who's in control here, the bank or the family? Many people think they own a home. They don't own a home. They own a mortgage. Many people are under the false pretense that they own a home. They do not own a home. They own a mortgage. Okay? So the principal paid would have been $102,000. That's what the versus $227,000. Right? So instead of paying $227,000 to bring their mortgage down, like towards the principal, only $122 went. So they paid more money. Are you understanding this? They paid more money to the bank, but less money went towards the principal of the house. More money went towards the interest. And they actually paid more money to the bank. They paid $41,000 more to the bank. The interest that they paid was $84,000. If the environment stayed the same, they would have paid what? 140 versus $145,000. So a $61,000 difference. They would have paid 84 instead of 145. That's why Albert Einstein said, and I would write this down. I know you heard it a million times, especially if you've heard me speak. You've heard it before, but I want you to write it down. Albert Einstein said, those that understand interest earn it. Those that don't understand it pay it. So right now, who is understanding the interest rate versus who's paying it? This family or the bank? Right? Now you get the picture. The bank is in control in this situation. The balance, look at the balance. The balance of the mortgage would have been $577,000 versus $597,000. So in every case, this is not beneficial for that family, that hardworking family, that when they are going to the grocery store already, they're struggling to pick up the milk and the bread and the eggs. You know, they walk into the grocery store, they come out, it's like $100. You can't go into the grocery store and spend less than $100 these days. The minute you go in, if it's a bag of any sort, right? If you're picking up one item, that's different. But if you go in with a bag or coming out with a bag, the bag is $100. It's $100. Make sense? So this family that's already struggling, all of this money that is being reeled back, you know, from the family into the banking economy, who loses and who wins in this situation? Who wins? Who loses? You want me to tell you? The family loses. The family loses. Right? Now, this $687,000 that they had, what if they took that 687? So remember I said, if the mortgage stayed the same in that 2.69 environment, right? And it didn't increase to the 4.59, it stayed at 2.69. That means their mortgage payments would have remained at $3,100 instead of $3,700. What would happen if they invested that difference? They took that $687 and they put it in an investment for 5 years. Okay, they put it in an investment for 5 years, and let's say they averaged 6% rate of return. What would happen? Well, that money would grow to $47,000, almost $48,000 interest not in interest, but in growth, right? They would have made almost $7,000 in interest. But you know what happened instead? The bank did this. That's when you hear these words, quantitative tightening, quantitative easing, you got to understand what they are and what they're doing. The bank is saying, we want our money back, right? They're saying, give me my money back. That money, that $687 could have grown for this family and earned them couple $1,000s in interest. They would have had $48,000 almost at the end of the 5 years, plus their mortgage would have been lower, plus their equity would have been higher. They would have more equity in their house because the balance of their mortgage would be lower. They would have been in a better situation. But who wins? Who loses? And I showed you a very, very conservative number, meaning how many families, let me go back here, how many families are renewing today $687,000 $79,000 mortgage. Not many. You know what they're renewing? 800,000, 900,000, 1 million. These people, their increase is not going to be $130. Their increase is going to be more like $400, $600, $800. Some of these people, right? They're going to feel the pinch. I showed you a very small conservative person that they paid their mortgage, didn't add any more debt. Some of these people, they have debts up to their eyebrows, mortgage in the house. You see a Lexus in the front, you see a BMW in the front, and all of it is debt, pure debt, 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 debt. These people are the ones that are going to feel it the most. These are the people where this 130 is going to be 400, 500, 600, maybe $700 increase. Never mind the real impact. Forget about the real impact, what that's going to be towards this family. They're really going to feel the pinch. And then on top of that, they have an OSAP loan and all of these things to pay off and credit cards to pay off, right? That's the difference. So how can you separate yourself and put yourself in a position where you never fall into that category? How can you set yourself up for success? And how can you put yourself in a position that it doesn't matter? You know, I received a text message because I'm going to read you the message. All right. I put a post. Let's see if I can still see the post. I put a post on my WhatsApp, and the person responded to me. Let me see if I can find it. Let me see if this was just yesterday. So I put here that I put $1.6 trillion will be erased, right? I posted that in our WhatsApp group, but I also posted it on my social media status about $1.6 trillion as the banks are doing their quantitative tightening, right? $1.6 trillion is going to be erased from families like this in an example I just showed you. But the total amount is going to be $1.6 trillion. And here's what the person said to me. She said, so now what can we do? What can we do? She says, I am up and down as the Canadian economy is going bad. She's going up and down with the Canadian economy. You know what my response was? My response was, you need to put yourself in a position so that the economy doesn't affect you. You need to set yourself up in a position so that the economy does not affect you. You got to separate yourself from what's happening in the economy. Because the economy goes bad, it doesn't mean your finances need to go bad. And she responded back, she said, well, it is hard. And my response was, not doing it is also hard. And doing it is hard. We have to choose which hard we want. All right? We have to choose. And she responded, we should have planned this and built our lives more reliable. Needless to say, we are setting up a time that we can have a conversation and sort out some of these things. But I want you to understand, the real idea is to separate yourself from what's happening in the economy. And debt is not the solution, right? So there's these 3 milestones to financial stability that I want to give to you. All right, it's going to change your life. If you understand this concept, it's literally going to change how you go ahead, how you move forward. It's going to make life a lot more smoother for you. You're going to be able to not be battered around. Like I remember when my brothers and I used to go fishing back in the Cayman Islands. We would go out in this little tiny boat, and when the weather is very rough, the boat is like moving around like crazy. Sometimes you're wondering, is the wave going to turn the boat over? Or are we going to sink, right? And then you would see some big boats going by, and the waves doesn't affect it. Doesn't matter how bad the waves were, the boats is just going no problem. And it's not affected by the waves at all. It wasn't affected by the current. While we're over there trying to struggle to survive, they're just cutting through the waves like it's nobody's business. And I believe this strategy will put you in a position where you can cut through the waves of the financial economy, no matter what's going on. No matter what the weather is like in the economy, you'll be able to cut through it and be okay. So there's these 3 milestones. Number one, the first milestone is building a foundation. Every good plan starts with a foundation. All right. And the second milestone is what we call gaining stability. So you're now stable. All right. And you're going to be as stable as you've built your foundation. And then number 3 is the optimal state. It's where you ideally want to be. Now, there's 3 categories that we're going to look at. Number 1 is we're going to look at the emergency savings. Okay. First thing we're going to look at is the emergency savings. This is the first category. The second category, by the way, emergency savings is your money that you put aside that you can use in the event of an emergency, good or bad, by the way. What's an example of a good emergency? Maybe a wedding, maybe an investment opportunity, right? So these are good emergencies. Bad emergencies, a death in the family, a medical emergency, the roof caves in, this kind of stuff, right? So emergency savings, you got to have money put aside that's your money. Now, at some point in your life, you got to make a decision that you're going to build an emergency savings and you ain't going to touch it. Like you're only going to use it for an emergency, a legitimate emergency, whether good or bad. Then the second category is the investment for retirement. This is number 2. And investment for retirement, many people ignore their retirement goals. It's like they didn't plan for it, or circumstances came up. They weren't able to save for it. Whatever the situation is, they're in a position where the retirement is on the horizon, but they're not yet ready, right? So these are some of the things we have to look at and make sure that we take care of. And the third category is the debt to earned income ratio. How much of your money is going out towards debt? So you earn X amount, how much of X is going towards servicing the debt, the car loans, the credit cards? So let's say that we have a family. Let's say that we have a family that's, earning $80,000 a year. That's a little bit over $6,000 a month. Let's say $6,700 a month. Let's say their expenses is $5,000 a month, right? Just fictitious, just to paint the example. And let's see what we can do, because many people, they only look at the optimal state. It seems too far, so they don't get started. I want you to hear what I just said. Many people, they only see the end goal. It seems way too far out of reach, so they never get started. Let's say that you had to eat an elephant. I don't know why you would want to do that, but let's just say for some reason you needed to eat an elephant. And how would you do it? How would you do it? You know how you would have to do it? You would have to break it down one bite at a time. And if you're able to do it one bite at a time, eventually you'd be able to eat the elephant. So in this first bite is the first milestone that we need to look at. All right? This is what we need to do. Okay? This is what we need to do. The first milestone, get $1,000 in your emergency savings. If you have 0, get $1,000. If you have 50, get $1,000. If you have $100, get it to $1,000. If you have 500, get it to $1,000. If you have 800, get it to $1,000. Your first objective is to get your emergency savings, a real savings, to $1,000. Not a credit card, nothing, right? The average person cannot come up with $1,000 without going to a credit card. The average person. If you're not there, thank God. Praise God that you're not there, right? You're ahead. You're ahead of most. But the average person, if you say, hey, show me $1,000 cash. Majority of people, they got to go to a credit card because they're living paycheck to paycheck. So the first thing is emergency savings should be $1,000. Second thing is investment going towards retirement should be between 5 to 10% of the gross income. All right. So that means if you're making $80,000 a year, our example here, right? $80,000 a year. Let's write it here so we remember. $80,000 a year. That's our example. Out of this $80,000 a year, or $6,700 a month, 5 to 10% of it needs to go towards saving for retirement. You say, Jermaine, but I don't know if I can do that. You got to get there. That's the foundation. That is the foundation. That means if you have to decrease lifestyle a little bit, you got to do that, right? You got to do that so you can build the foundation. That's around $300, $330 to $660 a month if you're making 80 grand a year. So if you're making $6,700, between 330 to 660 of it should go towards at some sort of investment, long-term savings for retirement. That's the foundation, right? And then the third part of that is your debt to earn income ratio should be 20%. What it means, no more than $1,300 should be going out towards debt. If more than $1,300 is going out towards debt, your debt to income ratio is too high. If it's higher than 20%, you're going to find it very, very difficult to pay that debt off. You know what I learned about debt? It's very easy to get into, but very, very difficult to get out of. Very, very. I remember when Tamoy and I, we were in $40,000 worth of debt. It was very easy to get into that debt. In fact, it was so easy to get into that debt. You get into this spiral, one thing leads to another, they start offering more money, and it's just like it'll never stop, right? You just feel like the taps have been turned on until one day you wake up, you're at $40,000, and the payment is pinching you. That payment is just hurting. Like it hurts every time you got to make that payment. In fact, something has to give, because the minute it's over 20%, you're going to start to feel that pinch, right? So make sure that you measure that, and that debt to earn income ratio is not over 20%. So in this case, if a person's making $80,000 a year, which is $6,700 a month, no more than $1,300 should be going towards the debt to in servicing any type of debt, right? So $1,300 is the max that should be going over here. 1,300. Okay, that's the foundation. This is when you build. You're not there yet. You're not at the optimal state, but you've started the foundation. What's the next phase? So you have $1,000 in your emergency savings. 5 to 10% of it is going towards your retirement. Your debt to earn income ratio is around 20%. What are you going to do now? Now, you should aim to move your emergency savings in the stability phase to 3 to 6 months. 3 to 6 months of your emergency savings should be put aside. This is where you're stable, right? These are the people that something happens in the economy, they lose a job, they're downsized. You're wondering, why aren't they so nervous? Why aren't they freaking out? It's because 3 to 6 months of their expenses is put aside. 6 months is ideal. I would say go towards the 6 months, right? Make sure you get to there. That's a half a year if you lose your job to find another job. That's a whole half a year. If you lose your job, you have 6 months, a half a year to find another one. You're not panicking. Right? If you don't do anything for 5 months, and then you get to month 6 and you're still looking for a job, you might start to panic, but that's a different story, right? That's a different situation. Call that procrastination. But that's different, right? But you probably won't end up there, seeing as you're a planner, you're a thinker, that you've already planned. You probably won't do that. And at that point, you should now have 10 to 15% of your gross income going towards your retirement savings, right? So going back here, 3 to 6 months of your expenses. That's $15,000 to $30,000. $15,000 to $30,000. So you move from $1,000 over to now $15,000 to $30,000 of your expenses. You are in a much better situation, right? You're not going to be bounced around so much. Who's going to be bounced around more? Person in milestone number 1 or the person in milestone number 2? Right? You're in a position that you can start saving more money. You put 10 to 15% of your money now towards your retirement saving. So you're not saving $330 anymore, instead $330 to $660. What are you saving now? Now you're saving $660 to what? $1,000 a month towards your retirement savings. You beefed it up. You're in a better situation. These are the people that you see, their confidence is not ever shaken by what's happening in the economy. These are the people that are able to act and carry out their lives regardless of what's happening in the economy. They can plan. They can act. Right? People that are not even on milestone 1, they are moving around with the economy. If the economy is going good, things are going good for them. If the economy is going bad, things are going bad for them. And then the debt to income ratio should drop to 10%. Okay, that means no more than $666 should be going towards your debt. Let's say $660. So you see what's happening. Your savings, your emergency savings is going up. The amount you're putting towards your retirement is going up. And your debt to earned income ratio, that means the amount of debt you're paying out, is going down. The money is going in the right places. Okay? This is why I explained to the lady. She said, it's hard. I said, you got to choose your hard. You got to choose your hard. Not doing it is also hard. Doing it is hard, but not doing it is hard. Right? So you got to choose your hard. Milestone number 3. This is the optimal state. Okay? Now, 6 to 12 months of your money is put aside for expenses. Imagine a whole year. Imagine a whole year of your expenses. So if your expenses is $5,000 a month, right? Imagine having $30,000 to $60,000 put aside. You think if this person gets laid off or fired or downsized, they're worried? They're not concerned. They have a whole year to get it together. They can pay their mortgage without missing a beat. They can pay their car payments without missing a beat. They can continue doing everything that they're doing they can continue taking their kids putting their kids in daycare. They can continue everything that they want to do because they've put aside a whole year's worth of their expenses. This is where the confidence comes in. You're not pushed and pulled by anyone. No one has their thumb on you. It's about saving the money and putting it aside. Right? We're in a society where people encourage you to spend. Spend, spend, spend. There's sales on everything. Buy, 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 buy. And you get ridiculed and laughed at if you're not keeping up with the Joneses. And we're encouraging you to save and put your money aside so that you can weather any storm. Doesn't matter what the newspaper says. It doesn't matter what the economy says. It doesn't matter what's happening. You can handle it. In the retirement section, you know what you're doing? You're putting aside whatever it takes for you to be on track for your retirement goal. Let's say your financial independence number is $2,000. You're putting away $2,000 a month. You're on track. You're doing what you're able to do whatever it takes because now you're in the optimal state. You're in milestone number 3. And then your debt to income ratio should be brought down to 0 because you should pay off all of your debts. And when I say all of your debts, I mean any debt that's not earning you money, right? So if it's a mortgage on a rental property, that's a good debt, right? That's a good debt. I'm not talking about good debts. I'm talking about paying off the Home Depot credit card or the Lowe's credit card or the Canadian Tire credit card. I once saw someone, they had a flip open wallet where they could go through all of those, store creded cards, Home Depot, Lowe's, Canadian Tire, this, that, Walmart, and all of the credit cards, right? Pay them off. Pay them off. In fact, if you have a $5,000 credit card and you're making the minimum payments, all right? You're making the minimum payments. Look at this. It'll take you 15.25 years to pay it off. You know what the interest rate is going to cost you? $5,500. This is why Visa loves many, many people. Visa loves you. MasterCard loves you. Home Depot credit card loves you. The total cost for you to borrow that $5,000 is $10,595. Let me go back to the statement that I asked you to write down. The people that understand interest earns it. The people that don't understand it, they pay it. In this case, Visa is understanding it very well. Right? Visa understands it. Now, what if you said, let me put an extra $100 a month on that credit card? You know what? All of a sudden, that 15 years drops down to 3 years. You know how much interest you pay now? $1,400 instead of $5,500. The total cost of your debt is $6,489,000. $6,489, pardon me. Who should the difference go to? Should it go to your family or should it go to Visa's shareholders, MasterCard shareholders, the bank shareholders? Where's the money better? You got to understand how the banks and these companies, they work as a business. When you understand this, then it's game on. It's game over. You're in a good position. All right? I want to end with this. There's these two mindsets. I read this book from Carol Dweck. It was a good book. I got a lot from it. Okay, it's called Mindset, and basically, I'm going to give you the premise of the book. Basically, is there's these two mindsets: a growth mindset and a fixed mindset. All right, and you got to determine which mindset you have. It's very important that you determine which mindset it is that you are operating with, because it's either helping you or restricting you. So a fixed mindset is basically that mindset where we believe our strengths and our skills, they're fixed in stone. And we only possess a certain level of intelligence, a certain level of strength. This is our personality. Have you ever heard the person say, oh, that's my personality, there's nothing I can do about it? Right? Oh, that's just the way I am, there's nothing I can do about it. That's called a fixed mindset, right? We understand that, or we see that when someone is, some of the people, they think they're even good at something, right? They're really good at math, or they're really good at athletics, for example. That's also a fixed mindset. So that's very important to understand. Fixed mindset people, they don't like receiving feedback. They don't like to hear from their bosses or their professors or their mentors, or they tend to take feedback personally. Fixed mindset people don't like to be challenged. If something's not working in their favor, they'll always come up with ideas and stories and way to spin it around and say, the reason I'm not successful is because this and that, or they have more talent than me, or they're more skilled than me, or they're more wealthier than me. And there's always a reason why they're not where they want to go. And yeah, the stories are false. They're not real, of course. But many people are feeling stuck. They're feeling like they're stuck in their comfort zone, and they don't understand how to get out, right? And what they need to understand and know is, if they don't stop avoiding it, nothing is going to change. So the growth mindset is the opposite. A growth mindset, what do we believe in the growth mindset? We believe that we can develop our skills. We can develop our strengths. We can develop our efforts. And we can grow, right? We can grow into the life that we want to build. Even though, let's say we are not good at math. Let's say we struggled in math class growing up. I did. I failed accounting. Right? But because I struggled in math class, I didn't let that deter me from getting inside the financial industry or going into business. Many people, I've heard them say, oh, I'm not good at math. I'm not good at accounting. I'm not good at business. That's the fixed mindset. The growth mindset is, okay, I'm not good at it, but I can get better at it, right? I can get better at it. I can grow into it. So if you're developing a growth mindset, you understand that your genetic structure and all of those things is not the final version of you. So even if you're somewhat good, it's not the final version of you. You understand that these qualities can be cultivated, you can change, and you can grow out of your comfort zone. You don't believe that anything is set in stone. You believe that you can constantly improve your skills, constantly get better. So if you want to become more athletic, for example, you're going to start a workout program. You're going to watch what you eat. You're going to start to get better and better and better. And you like to encourage the people around you, your family, your friends, your life partner. You like to help them to develop their own skills in their own way, right? What are some of the things that the different mindset says? The growth mindset, they say failure is an opportunity to grow. If you say this, you have a growth mindset, okay? What the fixed mindset says, failure is the limit of my abilities. They limit themselves to their abilities, okay? What the growth mindset, I can learn and do anything that I want to do. This is a limitless mindset. But the fixed mindset says, I'm either good at it or I'm not good at it. The growth mindset, they say feedback is constructive. They like feedback. The fixed mindset says feedback and criticism is personal. Ouch! They take it personal. Ooh, that hurts, right? Growth mindset says, I like to try new things. You know, my son and my wife and I, earlier this week, you know, I've been encouraging Dylan to try things, right? He doesn't like this particular food, for example. He doesn't like fries or this, or just try it. You won't know if you don't like it. And the other day, my wife said to him, he wanted to try something. And my wife said to him, Dylan, I don't think you're going to like it, because he really didn't like it before. And you know what he said? He said, Mommy, I don't know if I'm going to like it if I don't try it. And she's like, whoa, right? The mindset. It's the growth mindset, liking to try new things. Make sense? You know, the fixed mindset says, I'll stick to what I know. I'll stick to what I know. The growth mindset says, my effort and my attitude determine my abilities. The fixed mindset says, my abilities are unchanging. I can't change. I can't get better. It is what it is. I'm no good at math. I'm no good at business. I'm no good at sales. I'm no good at talking to people. I'm no good at studying, right? The fixed mindset says, my potential is predetermined, as if it's somehow written in stone that they have to be the way that they are. While the growth mindset says, challenges help me grow. Challenges help me grow. They see it as someone like doing weight resistance. As the muscle is being resisted, it grows. A muscle does not grow unless it feels resistance, right? So the resistance, the challenge, the growth mindset says that helps me to grow. The fixed mindset says, I don't like to be challenged. I want to stay comfortable in my comfort zone. It says, I can either do it or either I can't do it. Either I can do it or I can't do it, right? They also say, when I'm frustrated, I give up. I give up when I'm frustrated. The growth mindset, they say, I'm inspired by the success of others. So I want to challenge you. If you have a fixed mindset, go towards a growth mindset. If you have a growth mindset, keep growing that growth mindset. Keep expanding that growth mindset. But a fixed mindset will never get you where you want to go in life. All right? This is my time for tonight. I hope that you got value from today. If you did, bring someone with you next Monday at 8:00 p.m. We are growing this organization. We are growing this movement, and we want to change as many lives as possible. There's no cost. There's absolutely zero cost to be on a Money Monday. We want to change people's lives. Financial literacy is needed now more than any other time in the history of mankind. And we're going to change families one family at a time. So hopefully you got value from today. Thank you so much for your time. God bless you. We'll see you at the top.